this is John from Options Trading Pilot. Today we're going to look at options and using options for income. So Options Trading Pilot, where my business partner and I trade every day. We trade options, commodities, cryptos, currencies, a little bit of everything. As we trade every day, we post for our subscribers in real time what our trades are, and we try to provide a reason why we're doing it. Probability, directional bias on the market, return to a mean. So anyway, we'll get into this, but Options Trading Pilot, we're going to take this is a learning series today, so it won't cover everything. You'll have to look at our other videos for some of the specifics. There's some of our disclosures there. It's just for entertainment and informational purposes, and you can read the rest of that. So we like to trade. I've been trading for over 35 years and still trying to figure it out sometimes. But how to trade options for monthly income. So we're going to look at the put options. But before we do, some of the key fundamentals that we use when we're trading, and these are on other videos, trading small, trading often. We looked at implied volatility rank to know if we should be selling credit or buying debit. We look at expected move. We don't try to be heroes. We don't try to hit home runs. We are base hit, double, and we'll take a triple every now and then. But we are very methodical, mechanical in our approach. Option volume, you have to have option volume to make sure the bid-ask spreads are tight enough and that you're actually having a liquid market to get in and out of trades. And then we look at the strikes, optimal strikes based on probability and the expected move and such things. And then again, we look at deltas, which directly goes into optimal strikes. So let's go into a little bit more of what a put option is. So a put option allows the buyer of a put to sell 100 shares or one contract in this example. So one contract, one option of a stock, and at the strike price before the option expires. The buyer pays for this opportunity. So a buyer of a put wants the shares to go down in price. So this applies no matter how low it goes. So if and we'll get into the example, but even if the value of a stock goes down to 1 or 0, I still, as a buyer, can sell those shares to the seller at the agreed upon price. So when the stock price goes down, all else being equal, for this example, there's several other things that will affect the stock price and option price, days to expiration, market bias, implied volatility, number of things. And those are all the Greeks, which will be in another and more advanced episode. So with all else without everything else being equal, when a stock value goes down, the value of the put will go up because it is worth more as it is as the stock's going down. So as a put seller, why would anybody do this? Well, as a put seller, you would receive a premium for taking this risk. So the risk as an option seller is that the stock goes below and sometimes way below the put's strike price. And we'll get into this in a minute. However, the seller still has to buy the 100 shares of the stock from the put buyer for a much higher price. So this is important that there's a risk reward here. And we'll look at that in a little bit further. So if the stock goes above the put strike price, on the expiration day, the option will expire worthless and the seller of the put keeps the premium. So I sell a put, say a 400 put, it goes to 200. Now I still have to buy it for 400. Not so good. However, if the stock goes from 400 to 450, I get to keep the premium. So not only, I did very well in that trade, I get to keep that premium, and we'll show you this. And we'll show, this is what we're going to focus on in this presentation. So let's look at the risk. There's generally two types of risks. There's unlimited and limited risk. Here's an unlimited risk example. And it's something you need to be careful of. We do trade these once in a while, but this is a very risky process, and I would hope that people would generally stay away from this unless you really know what you're doing. So I would sell one June 17 SPY, the S&P 500, 380 put. The seller receives $6.91 per share, which is $691 per contract, and you can see that in the screenshot below. And the seller's risk, though, is $37,309. That's how much you could lose in this trade, which is the strike price less the premium received, and it assumes a price that it could go to zero. Now, will it go to zero? Probability is very, very low on that, but that's how these are looked at for unlimited risk. So is there a better way to play this? I like getting $691, but I don't want to lose potentially $37,000 on this trade. So is there a better way? Here's another way. Better, that's up for you to decide, but limited risk is, while you limit your risk, you also limit your gain. And this is what, in this example, is called a bull put spread. So you want the market to go up, but if it goes against you, you're not going to jump off a building because you just lost, 10,000, 20, 37,000 in this particular example. So as before, you're still selling a June 17 SPY 380 put, but you also can buy what I call an insurance put, and you buy a June 365 put for 468. So now you're selling one and buying another. Now you've limited your risk, but you're also capping your potential gain as well. So now the seller receives $2.28 per share, equaling 228 per contract. And you can see the probability of profit, the POP on the last was 78%, where this is 75%. So the probability of winning on both are about the same, but your risk in this example and your gain is capped. So you can see here, we are sell to open the 380 and buy to open the 365. Now I've picked these strikes partly because I'm going out 45 days to expiration. I'm looking at the expected move and I'm moving outside of that. So I'm not doing something right at the money. I don't want to I like to be right, but even if I'm wrong, I don't want to lose money or too much money. So if you move out of the expected range, you can still make a nice return if you're right on the trade. So here you can see now my risk is $1,272. This is the difference between the strike prices less the premium received. So it's 380, what you sold, you bought the 365. The net that you received is $2.28. Now your risk is 12.72 points, and that is equivalent of a little under $1,300 risk. So very interesting when you look at this. I still think these trades are really great, and they're not super sexy. They're not going to get you written up in any magazines, but it's akin to kind of scraping crumbs off the ground, and you can make a lot of money picking up crumbs sometimes. If you're right on this trade, meaning you want this price of the S&P to go up, and if it does close above 380 on expiration date, we generally don't hold all the way to expiration, but in this example, I'm keeping things simple. But if you're right on the trade, you'll make $228 for risking $12.72. So, or it's a non-annualized return of almost 18%. I don't think that's bad. Actually, I think that's pretty good. And you repeat this and repeat this and repeat this, and do it several hundred times, and you can make a living out of it. So the same strategy can be used on the call side, using what's called a bear call spread. So now you want the market to go down. And again, you could sell a naked call and have unlimited exposure up, Or you could buy a spread like we did, where you're selling one closer to the money, buying one for insurance out of the money. So same concept, up or down. The key is on picking the right strategy is you trade directionally. If you have a feeling that the market's going up, you can do a a bull put spread, or if you think it's going down, you do a bear call spread. If you think it's going to just be range bound, you can combine a put spread and a call spread together, and that's called an iron condor. Now you have risk on both sides, but you have premium received on both sides. And that's for a future show. But you receive premium on both sides, and you can only lose on one side. You can't lose on both simultaneously at expiration. So you want to trade using probabilities and expected moves. That's all we do all day long, is look at probabilities and expected moves, standard deviations, and it's key. Trading small and trading often, use the law of large numbers. This is not about a one trick, let's go out, hit a home run, buy a car. Even though we had somebody recently who traded with us and did really well, and apparently bought a house or put a down payment on a house. So you want to trade consistently over time. This is not akin to going to the casino and putting it all on red. This is a very methodical, maybe someone would call boring approach to option trading. But I'd like to do option trading for another 30 years, not for another month. So I'm going to stick to our mechanical trade. So always know your risk and what you are comfortable losing. You have to go into the trade. You have to be positive that you could earn $228, but you also have to say, well, what if I lose $1,200 on this? What's it going to do for me? You must keep emotion out of your trades, win or lose. I don't get too excited about a win, and I don't get too excited about losses most of the time. It's just a better way to be. It's very similar to poker. I don't think you should really get excited or get too disappointed on things. You just work the probabilities, work the law of large numbers, trade a lot, trade small, keep moving. So in our example on the last side, if you were correct on the trade, you would have made $228 at expiration. And the idea is that with our techniques and what we use, which if you subscribe with us, you can see real time what we do every day, is this type of trade can be repeated over and over and over and over and over. And it does not matter if we're in a bull market, a bear market, a neutral market. And not to say we'll win all the time, but you can trade all the time in different markets and how you want to trade. So very short, it's a high level. There's too much detail. I'd be talking for hours to get into all the detail, but this gives you a good high level look at some of our other videos, and we have future videos coming as well. Thank you. Please leave comments in the comment section below.